Most of you probably know CVS, but CVS is not just any company. CVS is 4th on the Fortune 500 list, right behind Amazon and Apple. In this episode we will discover how CVS grew this big, how their sales and profits grew alongside it, and what shape the company is in now. Make sure to watch until the end, because as icing on the cake we will take a look at the valuation and the future of CVS. Also, do you know what CVS actually stands for? No? You will find out in a bit. A little disclaimer, I do own shares of CVS. CVS fills over a quarter of all the US drug prescriptions, has 9,900 plus retail locations and 1,100 minute clinics. On top of that, they bring in more revenue than almost any other company I've covered so far, and they bring in more revenue than companies like Google, Microsoft, Costco and Home Depot, to name a few. CVS had a massive acquisition of Aetna in 2018, which was the third largest health insurance provider at that time, to form a healthcare giant. But how did CVS turn into the company they are today? It all started in 1963, where the first CVS store was opened in Lowell, Massachusetts, by Stanley and Sidney Goldstein and Ralph Hoagland, at that time under its full name Consumer Value Stores. From the start there was no messing about, because in their first year they opened 17 stores. Then in 1969 the company was put up for sale and was bought by Melville, primarily a shoe company at the time. And that was the start for a massive expansion and a true acquisition spree over the next 50 years. In 1972, with a capital injection from Melville, they bought 84 stores of Clinton Drug. Then in 1977 they added another 36 stores by acquiring MacD Drugs. For over a decade it went silent on the acquisitions front, but then in 1990 they acquired People's Drug Stores, adding 490 stores. At that time Melville still owned CVS and a few other stores, which all became CVS, and that is also the name they went public with on the stock market. In 1997 they made their biggest acquisition to date in terms of stores added, by acquiring Revco, which added 2,600 stores. The next year they bought Arbor Drugs, adding another 200 stores. But then they made a different kind of acquisition, because they bought Soma.com, which later became CVS.com. And this is part of the DNA of CVS. They acquire companies to adapt to the changing landscape all the time, which we will see more examples of in a bit. In the zeros they acquired 4 more store chains, adding more than 400,000 extra stores. The most notable one is the acquisition of Target pharmacy stores, by which they bought themselves a presence in one of the biggest retail chains in the US. And these acquisitions were necessary to fight off their long-term rivals Rite Aid and Walgreens, both of which were bigger than CVS in the late 80s in terms of stores. But by 2006, CVS also started to make different kinds of acquisitions, strengthening their existing portfolio instead of buying more stores. I guess by now you see that CVS really grew this big by doing a lot of acquisitions. And this is important to keep in mind, because this shows that CVS is a serial acquirer that is very good at expanding through acquisition and integrating those companies within CVS. This is a very important skill to have as a company to fight off competition and keep your sustainable competitive advantages. A skill that came in handy not even a few years ago with the acquisition of Aetna. More on that in a bit. The 1,100 minute clinics CVS has now, in which you can see a nurse and get basic healthcare and prescription drugs. Yeah, you guessed it. CVS acquired those in 2006. CVS Caremark? CVS acquired Caremark a year later in 2007. Caremark is a PBM, which stands for Pharmacy Benefits Manager. Basically a PBM administers drug plans for employers, and they also negotiate with drug companies for discounts. So the acquisition of Caremark again was one to strengthen the footprint of CVS as a healthcare company, so they could offer more value to their customers. It also meant CVS became more and more of a one-stop shop for healthcare. Before we continue on to their last 2 acquisitions, let's take a look at how sales developed for CVS as a result of all these acquisitions. Their sales grew for an average of 16.8% over the last 10 years, with a big jump in 2019, as the revenue of Aetna was added that year. But there is a steady uptrend that we can spot here, so that looks good. There's more to the story though, so let's not only focus on sales growth. First, back to the acquisitions. In 2015, CVS acquired Omnicare, which offers pharmacy services to long-term care facilities. In the press release, CVS stated at that time they acquired Omnicare for $12.7 billion. because they want to expand their ability to dispense prescriptions to assisted living and long-term care facilities. So it is very well possible that the tenants of Omega Healthcare investors receive their prescriptions from CVS as well. Why do I mention this? Because I also happen to own 50 plus shares in Omega Healthcare. If you want to know more about the high-yielding dividend stock that Omega Healthcare is, check out episode 47, now suggested in the top right. Anyways, let's take a look at the margins of CVS and the net income. Because there's a little cautionary tale in there. So far, all we've seen from CVS looks pretty good. But the margins of CVS are quite thin, which could be problematic because it leaves less room for error. Something that CVS itself also mentioned in its annual report as a risk to their business, because they are in a highly competitive business in all of their business segments. The gross margin of CVS is at 18%, but the operating margin is at 5%, which is quite low. However, not at all uncommon in this industry, as Walgreens is slightly lower and Rite Aid is only slightly positive. That also translates to the net income of CVS, which is growing steadily over time, but is only a fraction of the massive revenue they bring in, with a profit of 7.1 billion in 2020. Back to the latest acquisition of CVS, which kind of shocked a lot of people, myself included, because of the sheer size of this acquisition. And that is the acquisition of Aetna in a $69 billion deal in 2018. This added a lot of leverage as the deal was funded with a lot of debt, and as a result the dividend increases stopped. More on that in a bit. As you can see here, the debt to equity doubled from 2017 to 2018 as a result of the acquisition. So it definitely brought some extra risk to CVS. Then why did they do it? Well, because Amazon was becoming more and more of a threat to CVS moving into the prescription drug business. So CVS did what it has always been doing, fighting off the competition by acquiring another company. And it perfectly fits into their long-term strategy of being a healthcare provider and not rely on their retail stores as much. This is also the story of CVS. They went from being solely a retail store to a full-out healthcare provider. One of the most important moments to illustrate this was the decision of CVS to stop selling tobacco in the stores in 2015. For perspective, tobacco was bringing in $2 billion in sales for CVS. But it makes sense to me, how can you as a healthcare provider still sell tobacco? So going back to today, CVS is now a one-stop shop for people with minor health issues, from diagnosing to prescribing drugs to health insurance. To be honest, the thought of how CVS was able to revolutionize the healthcare system in the US kind of baffles me as someone from the Netherlands. In the Netherlands, healthcare insurance is mandatory. When you have a health issue, you go to your GP of choice. He prescribes the drugs and you can pick it up at an independent pharmacy, usually for free, because the health insurance takes care of the rest. Anyway, got a little bit off track here. Before I mentioned that CVS has stopped increasing their dividends until they get the leverage of the Aetna acquisition down. Let's take a closer look at the dividend profile of CVS and what that means for them. But first, a bit about me and this channel. I'm Tom from the Dividend Attitude Show, and on this channel I make in-depth videos about dividend stocks. I do dividend battles between two stocks in the same industry, top 5 videos, and I give monthly updates on my portfolio. I made this video as a result of a recent poll I did on our YouTube community, in which Home Depot got the most votes, but CVS came very close, so I decided to make a back-to-back video with in-depth dividend stock analysis. If you also want to vote on what future videos I make, be sure to subscribe because I will continue to do these polls in the future. Back to the dividends. The current yield is at 2.3%, the lowest in years. The 5-year dividend growth rate is still listed at 5%, but like I said, there have not been any dividend increases for a few years. CVS said when they acquired Aetna that they would start to increase dividends again if they brought their leverage down to the 3x level. They are well on track to do that in 2022, so I'm hopeful that we will finally see a dividend increase again in 2022. Their earnings payout ratio of 26% and free cash flow payout ratio of 21% support that thesis, as they will have plenty of room to increase their dividends with these ratios. Simply Safe Dividends does have the safety score at 67, which is safe but could be higher. This most likely has to do with the current debt levels and the uncertain future. Let's put our investment goggles on to check how healthy the balance sheet of CVS is. We have already looked at the debt to equity ratio, which is higher after the Aetna acquisition, but coming down as CVS is paying down their debt. But what about the short-term risk by looking at the current assets versus the current liabilities? The current ratio of CVS is below the minimum level of 1 at 0.91. I'm not sure why CVS holds so much current liabilities, so that's something to look into. For comparison, their direct competitor Walgreens is even lower at 0.67, so it might be industry specific. The quick ratio, so the most liquid of assets versus the current liabilities, is at 0.53, so well below the desired minimum level of 1. These could indicate that CVS has trouble paying its short-term obligations, but looking at the last 10 years, both ratios have always been around these levels, though slightly declining. Now, with our investor goggles still on, we also want to know how well CVS is with managing money given to them by shareholders in the form of equity and in the form of debt with loans. For the first one, we look at the return on equity, where above 10% is desired. CVS is at almost 11%, so that looks good. The return on invested capital shows us the return with money invested in CVS both in the form of equity and in the form of debt. For CVS, this stands at 6%, which I would like to see higher, also towards 10%. The S&P credit rating of CVS stands at BBB, which is still investment grade. Before we take a look at the future of CVS to see what growth opportunities they might have to grow even further, let's take a look at the valuation of CVS. Because of the size of CVS, I would expect them to be overvalued, but surprisingly they are severely undervalued according to FastGraphs, with the black line way below the fair value, orange line. If it would return to fair value by the end of 2022, you could see an annual return of 27%, and even 32% if it would return to historical market value, the blue line. Those are some serious numbers. Well, actually, I would be lying if I said I didn't notice, because I specifically added to my position twice already because I think they are so undervalued. Looking at some of the valuation metrics on Morningstar, like price to earnings, price to book, price to sales and price to cash flow, CVS looks undervalued on all accounts, compared to the S&P 500. But the big question is, can CVS keep growing their sales and consequently their profits in the coming years? One of the main drivers for CVS, now that it turned to an almost full-fledged healthcare company, is the aging population and the ever-increasing need for healthcare. But what will continue to be a theme as well is the fierce competition in this space, where Amazon once again also plays a factor. CVS obviously tries to mitigate this threat and has taken concrete action with the acquisition of Aetna, which really seems to be paying off so far. For perspective, the revenue of the first quarter of 2021 alone was 69 billion, so the same amount as they have paid for Aetna. Looking at the hard numbers, analysts on FastGraphs expect CVS to grow by 2% in 2021, but 7 and 8% in the years thereafter. As a dividend growth investor, I obviously would like to see dividend increases again. If you are looking for a company with a similar current yield but also fast growing dividends, check out the video on Home Depot, which you can watch by clicking on the right video. I'm off, until next week, bye bye.